Hey everybody, welcome back to the Mark Loeffler Experience. Today we're going to cover options. I know that all my guests that I've had on so far have talked about options and trading options and what they're doing in the stock market and how they're making money. So I'm going to go through a simplified what options are and how you can use them effectively in your portfolio to help make income and to increase your returns. By the way, everybody, if you're new to the channel, definitely subscribe. Smash the like button for the YouTube algorithm. If you guys get something out of this or if you want more resources, comment down below. Happy to do these videos. And guys, these all come from your comments. So the more you comment and ask and make suggestions, the more videos I do. I don't know if that's a threat or a promise. I don't know yet. All right, so let's talk options. So what is an option? So I know a lot of the guys talk about that we do naked puts. What's a naked put? So essentially a naked put is I'm selling insurance. So I'm now in the insurance product industry, so I'm selling insurance. So for instance, let's talk a nice safe stock, Bank of America. I mean, who knows if it's safe in all this world or not, but Bank of America. So currently right now, Bank of America is around $24, $25. And I'll give you exact numbers because I do this all on my phone. Doesn't take very long, doing about 15 minutes a day. So, okay, right now, Bank of America is $24.66. And what we'll do is we'll put up the options chart from, like, say, Yahoo Finance on this as well, so you guys can kind of see what's going on there. All right, so it's gone up 2 cents. So, for instance, Bank of America. If I like Bank of America, I'm thinking it's a good stock, great. Then I can go out and I can say, I like Bank of America, $24.67 seems a little rich in this environment, or maybe it's a great price and who knows. Yet I can come and write I always go out probably 6 to 8 weeks when I write my naked calls. And so I can basically insure that that stock for somebody that if it goes below $20, so it's $24.68 right now. I'll write these things down because I know. So $24.68 is what it's at now. So I can insure it for $20. So if it goes below $20, then, and typically 9 times out of 10, if it's below that on the before, I don't I don't have to buy the stock. It's only on the expiration date that I'd have to buy it. So if it's below $20 on June the 19th, then I would have to buy that stock. And for the privilege of that, right now, I'd get paid 45 cents. So you have to do these in 100 lots. So that's $45. So I would risk $2,000 to make $45. I mean, that doesn't sound like a lot of money, does it? Yet. So June 19th is about 6 weeks away, 6.5 weeks away. And $45 of $2,000 is just a little bit over 2%, 2.25%. So in 2 months, 6.5 weeks, I can make so a little over 6.5 weeks, I can make 2.25%. Now, guys, I know some of you option traders out there right now are going to tell me, well, Mark, that's not really how much I'm using to buy this, to do this stock. Well, and it's true because to do options, you have to have a margin account. So really, you're using about $600 to make $45. So I don't even know what that is. That's 7.5%? No, probably more than that. Listen, I got a calculator here. I can actually use the calculator this time. It is 7.5%. I was right. So 7.5%. So guys, again, I know all you option traders out there are going to tell me, Mark, I don't need to use $2,000 to make this trade. And it's right, because in Canada, we get about 3.3 times. So it's about $600 margin for me to do this, and I still make the same $45. So now my return is 7.5% for those 6.5 weeks. If you're in the States, you guys are way better. You only need $400 because you guys go 5 to 1. Now, am I going to tell you to go use all your margin? Because no, because if there's a downturn, you're going to get slammed. Right, Jeff Borum? So, I mean, there's a book that you can see who's swimming naked when the tide goes out. Well, you can see who's using too much margin when the market goes down. All right, so now my return is what? Almost 11%? More than that. 11%. So, guys, all I'm doing here with my naked puts is now I'm taking that, I'm making my 2%. This is my goal, is to make 1% a month basically on these stocks. And I'm probably going to do this trade today because this is a good trade in my opinion. So 2.25%, and basically all I'm doing is I need to roll that money. So all that comes out, and I make my 2.25%, and it gets paid to my account right now, and I continue to make money on that money. So, all right, I think that explains naked puts. And let's talk about compounding, how this works. So let's say I make 2% per month on my money. Annualized, everybody's going to tell me, well, Mark, that's probably 24% per year. And I'm going to tell you, you're probably wrong. So you got to do 2 times 2%, so it's 12 exponential. So it actually works out, 2% per month actually works out to about 30% per year return. So if I can make 2% a month and 30% a year on safe stocks that pay a good dividend, if I have to buy Bank of America at $20 and collect a dividend, and I'm just going to write calls on it. I mean, you saw from my last video from last Thursday, the Royal Bank trade I did. I bought that outright. I sold calls on it to produce income. And I think I forget what the return was on that, but it was 15% in like 2 months, maybe even a little bit higher. And I didn't even talk about using margin on that point. So if I can just do 2% a month, I can do 2% a month pretty easily without using any margin. Right, Omar? 2% a month gives me 30% a year. So 2% times 2% times, well, you can do the math looks like this. If you want to go ahead and do it on your calculator, it's 1.02 times 1.02 times 1.02 times 1.02, and you do that 12 times to get a year. All right, guys, that's the simple naked puts. Now, I have talked about covered calls in here too, and that's simply the opposite. So a covered call is, if I had to go ahead and buy that Bank of America, BAC, at $20, well, now I could go ahead and sell a $20 covered call on it. And I'll give you real numbers again. Well, it's not going to look that good right now if I had to buy it then. But basically, a covered call at the strike price for, say, 2 weeks away is paying me about 3%. So it'll probably pay me around $60, or 0.60 per contract. And now what happens is I'm obligated to sell that stock at $20 if, say again, June 19th, that stock is above $20. If it's below, I just keep the premium and I just keep rolling. So what's the goal with me selling my naked puts or covered, well, my naked puts mainly. For me, selling naked puts is, the goal is honestly never own a stock. 85% of my puts expire worthless. So what that means is I keep the premium. So the money they paid me, I keep that, and it just expires. So it's basically, it's zero. They walk away, they paid me their money, I've covered my insurance. So I liken it to this. How long have you been paying auto insurance or home insurance, and you've never had a claim? It's the exact same thing. So this is how insurance companies make their money two ways: is they collect premiums from you, and then they invest those premiums to make a return. And yet, if they only have to pay out on 15% of the people who get insurance, then they make money. Right? So 85% of my puts expire worthless, and the 15% that don't, I usually just take the stock, I write a call on it, and I'm patient to get out of that stock. And typically what will happen is I'll write it at a bit above what I own it at, so I'll make a little bit of a lift. I'll make the call, I'll make a couple of dividends on it. And I mean, last year in this strategy, I made over 50%. Like you heard Jeff Borum talk, he was over 70, I think 78% or something last year using this strategy. Now, if you're going to get into this, so there's two books I recommend. Number one is Derek Foster, which we've talked about before on this channel. We'll put the book up here and link below. And the other one is Lee Lowell. So Derek Foster is going to talk to you about doing naked puts on stocks that you love to own, that are good dividend producers, and he just uses naked puts as a way to get some more income and to maybe buy that stock at a cheaper price. Because again, I do that Bank of America at $20, and if I have to own it, then my price actually is $19.55 because I collected a 45-cent premium on that. I know it's not that much, yet it's a bit of a discount. So if that stock ends up at $19.80, well, I'm still up on that stock. Right? So this is what Derek Foster does, and he uses to buy long-term holds on good dividend-producing stocks. And then you got Lee Lowell, who get rich with options, which again we'll put up here in the link down below. And Lee talks about doing naked calls and naked puts and covered calls. And I mean, he has different strategies in that book, yet those are the two ones I primarily stick with. I mean, because it's simple. I can do this in 15 minutes a day from anywhere in the world. I can be sitting on the beach. As long as I got access to the cellular data service or Wi-Fi, I can be making trades. So guys, you like this strategy? We'll get more people on to talk about this who are doing it. Most of the people I know are doing this now because the returns are great. So comment down below. Are you selling? Are you doing options? Are you doing anything different? Are you selling? I mean, like a lot of the guys I know now do like iron condors and bull put spreads and all this fun stuff. I like to keep it simple, guys. I don't like to be too fancy. It makes me nervous what some of these guys are doing. Yet, keep it simple. You can make decent returns. And worst case, I own good dividend producing stocks that I hold on to that I'm happy to own. All right, guys. Well, thanks so much for joining us. Make sure you subscribe, smash the like button. We'll see you guys next time.